Most major U.S. markets are poised for a flat to negative return by year end. But what will happen next year? And how can investors profit? Joining me is John Donaldson. He's Chief Fixed Income Strategist at Haverford Investments. John, welcome to In Business. I feel like
Thank you very much, Margaret.
Fixed income is almost always the front lines for where you want to see an impact of an economic event, but I feel like it's really moved to the front page and focus of the business world right now. What is it indicating for what's next in 2012?
Well, I think where we stand today, because as I was getting ready to come on the air, the 10-year Treasury was ticking right around 2%, 199, 2%, 199, 2%, and we see that kind of level as saying that the seesaw of sentiment is still very much tilted toward pessimism about the economy, pessimism about the developments in Europe. And at some point in the year, we do think that that heavy level of sentiment on one side will give way a little bit and people will question that consensus that's led us to be at these levels. So you're going to see interest rates trade up at least somewhat during the year.
Well, we mentioned equities and what equity markets are doing because it seems the market participation is coming away from this space, and there's a lot of money flowing in to Treasuries and other asset classes that are viewed as safer bets. I mean, are you considering the Treasury to be the safest bet out there, or do you prefer perhaps Germany or other sovereigns?
Well, I think one thing you want to do is keep away from too much myopic looking at relative spreads in the fixed income market and occasionally step back and look at the absolute levels of the market. And returns of 1.92% in that range offer you very little income protection against any price erosion. So we'd say, Treasuries, absolutely, you will get paid your principal at maturity. But at these levels of interest, you really aren't compensated for the volatility that may be there, and also the fact that we're still running trillion-dollar deficits and the Treasury is still issuing $100 billion of new money each and every month.
Right. Right. Well, I was talking to a chief economist at J.P. Morgan, and he said given the uncertainty in Washington that remains and that in Europe, he could see 40% or higher chance that we see more quantitative easing in the new year. Are you betting on that?
I think we'd say we do not think that there is a high probability of further large-scale quantitative easing. I think we would expect to see perhaps some of the coordinated efforts between the Fed and other central banks to try and ease any strains on the system. But we really don't see, well, the moves to allow swaps among the central banks, particularly to ease funding concerns in Europe. A lot of that comes from what's happened in this country, where all of the money market funds have reduced their exposures to European institutions as much from shareholder pressure as anything else. Well, that all of a sudden dried up all the dollar funding for all the banks in Europe. You have to replace that somehow so that two central banks do a coordinated swap to make funding available where the market's taken it away.
So you would expect more activity on what exactly, though? I mean, what, if not quantitative easing, what kind of coordinated action should we be prepared for?
I think from the Fed in our market, again, maybe some policy moves around the edges. We do not see a $500 billion of additional bond purchases.
But mortgage-backed security purchases have been sort of the presumption. Do you believe that that will continue or be relaunched?
They won't go beyond reinvesting the maturing and rolling over securities. No new money.
No new money. All right, John, thank you very much for those predictions for what to expect in the new year.
Margaret,
I appreciate it.
Thank you very much, and happy holidays to everybody.
You too.